Hello everyone. Welcome back to the channel. In today's lesson, we're going to break down one of the most important and most misunderstood concepts in accounting, debits and credits. If you truly want to understand accounting, not just memorizing entries but actually thinking like an accountant, then you must master this concept. Don't worry. By the end of this video, debits and credits will finally make sense. Let's get started. 1. What are debits and credits? First, let's clear up a very common misunderstanding. In everyday language, debit often means money taken out. Credit often means money added. But in accounting, debits and credits do not mean increase or decrease by themselves. In accounting, debit, DR, simply means the left side of an account. Credit, CR, simply means the right side of an account. That's it. Accounting is based on a double entry system, meaning every transaction affects at least two accounts. One account is debited. Another account is credited, and the total debits must always equal total credits. 2. The foundation, the accounting equation. To understand debits and credits, we must return to the foundation of accounting. Assets equals liabilities plus equity. This equation must always remain balanced. Now here's the key rule. Assets increase with debits. Assets decrease with credits. But for liabilities and equity, it's the opposite. Liabilities increase with credits. Liabilities decrease with debits. Equity increases with credits. Equity decreases with debits. Why? Because the accounting equation must always balance. 3. The 5 major account types. There are 5 major types of accounts: assets, liabilities, equity, revenue, expenses. Now here's how debits and credits affect each one. Assets, increase debit, decrease credit. Examples: cash, equipment, inventory, accounts receivable. Liabilities, increase credit, decrease debit. Examples: loans payable, accounts payable. Equity, increase credit, decrease debit. Examples: owner's capital, retained earnings. Revenue increases equity, so increase credit, decrease debit. Expenses reduce equity, so increase debit, decrease credit. Shortcut rule, very important. Remember this: ALER, D dividends, E expenses, A assets, these increase with debits. L liabilities, E equity, R revenue, these increase with credits. If you remember DEALER, you'll never get confused. For how double entry works, let's apply this with practical examples. Example 1. Owner invests $10,000 cash into the business. 2 accounts affected: cash, asset, capital, equity. Cash increases debit. Capital increases credit. Journal entry: debit cash $10,000. Credit capital $10,000. Balanced. Example 2. Business buys equipment for $2,000 cash. Accounts affected: equipment, asset, cash, asset. Equipment increases debit. Cash decreases credit. Journal entry: debit equipment $2,000. Credit cash $2,000. Still balanced. Example 3. Business earns $1,500 revenue in cash. Accounts affected: cash, asset, revenue. Cash increases debit. Revenue increases credit. Journal entry: debit cash $1,500. Credit revenue $1,500. Again, total debits equal total credits. 5. Why debits must equal credits? This is the beauty of double entry accounting. Every transaction has 2 sides. You receive something, you must give something. You gain value somewhere, another account changes. This ensures the accounting equation remains balanced. Financial statements remain accurate. Errors can be detected through a trial balance. If total debits don't equal total credits, something is wrong. 6. Common mistakes students make. Here are common mistakes. Thinking debit always means increase. Thinking credit always means decrease. Forgetting that different account types behave differently. Always ask, what type of account is this? Is it increasing or decreasing? What is the rule for that account type? That's how professionals think. Conclusion. Let's summarize. Debit equals left side. Credit equals right side. Double entry means every transaction affects at least 2 accounts. Total debits must equal total credits. Remember DALER. Debits and credits are not difficult, they are logical. Once you understand the structure behind them, accounting becomes much easier. If you found this explanation helpful, don't forget to like, subscribe, and share this video with someone learning accounting. See you in the next class.